Let's get to the markets. The big issue, looking for a trade truce to turn into a sustainable agreement.
We all talk about trade and we're all worried about trade.
A lot depends on what happens on the trade front.
The market is expecting to see some clarity.
Both President Xi and Donald Trump need a deal.
This stop-go, just stop at the edge of the cliff, is enough to trigger precautionary easing by central banks, but not enough to really damage the economy.
The absence of a trade deal and the trade tensions is already impacting corporate earnings growth, just not in the U.S.
The back half of earnings season is industrials, it's tech hardware, it's all of the sectors that are most exposed to the supply chain issues we've seen, to the China trade issues we've seen.
Until we actually get like a real final result and agreement, I think Wall Street is still a little hesitant.
It's just simply too early to tell how some of these things are going to play out.
So the key question for investors, can central bank easing help markets weather the storm? Joining me around the table, Julian Emanuel of BTIG, Binky Chadha of Deutsche Bank and Robert Tip of PGIM. Julian, let's start there. Can they? Can central banks help us weather the trade storm?
Only to a very limited extent. I mean, you look at it, particularly in Europe, you can see that that monetary policy has really run the course of its effectiveness. And in the U.S., there are obviously lots and lots of inputs into this and lots of cross currents. But the bottom line is, interest rate policy cannot change the fact that global supply chains are being disrupted, and can't change the fact that literally every trade war in history has proven to be disinflationary, and this one is no exception.
The data over in Europe, absolutely terrible. Some really ugly PMIs that we'll talk about a little bit later in the programme. Binky, what's your take at the moment on things as earnings continue to come through?
So, first on the question of, can the central banks make a difference? I mean, the way I think about it is, if I think about how easy ECB monetary policy is relative to, sort of the way that it thinks about easing as being positive, basically, for the economy, I would put it at, relative to history, somewhere 90th percentile, 93rd percentile, so going to 97 or 99, if 93 is not making a difference, do we really think that 99 is going to make a difference? In the U.S., interest rates relative to any rule that would explain the historical behavior of interest rates, and you can be as generous as you want with the parameters, will tell you that, we're probably 2-3 percentage points below where we are. So monetary policy is already very, very, very expansionary in the US and in Europe. And so what we are talking about is marginal takes. I would add one more point.
Please do.
And what I would say is, if you think about the 19 central bank easing cycles that we've seen since the 1950s, about half of them, ended in full-blown recessions. Half of them didn't. The market is treating this very much as a shallow or a mini easing cycle. And the distinguishing feature, the key feature really of a mini easing cycle is a very quick turnaround in growth in a couple of months. And that suggests historically, it's not really been about monetary policy easing. There's some sort of shock that slows growth. The central bank eases with a lag. But it's either that shock got absorbed or, the shock just simply went away. And right now, it's, as you said in your opening, it is the trade issue. And that is why global growth and U.S. growth have slowed for a year and a half. And unless that goes away, what's monetary policy?
It is